Alrighty, welcome to Teach You Academy. And today's topic is going to be debt to income ratio impact on credit and loan approvals. So, impact on credit and loan approvals, impact on credit scores. DTI is not a direct factor in credit scores. FICO, Vantage scores. Scores are based on payment history, credit utilization, credit age, credit mix, and inquiries. Indirectly, high DTI may increase utilization or miss payments, which can lower scores. Impact on loan approvals. Lenders use DTI with your credit score to determine approvals and rates. Common debt to income limits conventional mortgages 36% up to 45% with strong credit. FHA mortgages 43% up to 50% with compensating factors. VA mortgage 41% flexible with strong residual income. Auto loan 36% to 45%. Personal loan is 36% to 40%. So your debt to income has to be within these margins right here. That's what the limits are. Good versus risky debt to income. 36% easier approvals and best rates. 36% or lower. Acceptable 37% to 43%. Possible approvals, higher rates. High risk is 44% to 50%. Severe risk is your 50%, often denied without cosigner or collateral. So your high risk 44% to 50% limited approvals, higher rates. Severe risk is 50% or higher, often denied without cosigner or collateral. How to lower debt to income before applying? Pay off small debt first, refinance or consolidate to reduce payments, increase income, side jobs, overtime, rental income, avoid new debts before applying. Credit check credit reports for errors inflating debt to income. Summary: impact on credit score. We talked about that. We talked about impact on your loan approvals. We talked about common debt to income limits, your good versus your risky debt to income, and how to lower debt to income before applying. This is Teach You Academy, and this is just educational purposes only.